so much. Thank you very much for giving us this opportunity, firstly, to contribute to the learning needs of here. And friends, I would just like to share, the opening, as an opening mark, please do not have any preconceived notion about the subject taxation. People hear taxation and then there are a lot of multiple interpretations about the taxation itself and what's going to cover. It's a very, very wide subject. And specifically when we are talking about the personal taxation, personal taxation has a lot many nuances around it. But what is important for this session and what we can bring as a relevance, which is associated with us when you and I as individuals are interacting with our family, friends, clients, customers, whoever whom we are interacting with, when we are assisting them with helping them in making an informed decision. The whole idea of today's taxation, or I would say importance of tax planning, is only to cover, what and how an individual should be able to select some of the choices to make their decisions a little more effective for them. So, in a while, I will probably share the slide, and again I will come back at the end, and then we will have a Q&A interaction or anything that you may want. Okay, the whole idea, friends, is that this evening will help us. The agenda is to look at taxation is a very important subject for all of us, if not many, it's for all of us, right? So on that note, friends, let me just quickly take you to today's agenda and what we have here with us. I hope you're able to see this, so it's not going to be a boring evening as far as we are able to connect to the subject today. Okay, so as I said in the beginning, okay, firstly, friends, I'm going to share with you, we are not tax experts, number one. Okay, we want to let you know we are just a mutual fund company engaged in mutual fund products, and that's precise. Okay, and whatever we are sharing here and whatever content we create here is basis the ideas that we get from various associates, and then in terms of the pain points that the investors have in when at the time of deciding what to do, how to go about things like that. And one of the ways that I would like to take this session is also to invite you to be in the investor's shoes, right? So when you are an investor and you want to make a decision, or when you are a taxpayer and you want to make a decision, how would you choose that? And that will help you and I to take it forward in being in the investor's shoes. So that's the disclaimer. I'm not going to go over that. So that's a part and parcel of our life. See, while tax is important, friends, my personal view is that every decision that we take on the investment should not be for tax saving purpose. That is not the whole idea of the personal financial planning, if I may say so, right? So the whole idea is we choose the products and make those products so efficient that they also help us in our tax planning. That is how we are going to look at it. It is not that we have to have something for tax, something for goals, something, all that. No. It is absolutely inside the personal financial planning realm itself. So this particular session will have cash flow management is very important. We are on the 8th month today. August is the 8th month of this financial year, and there are people who would have already planned and chosen some of these options, and the people who are still struggling or grappling with, there could be people outside, whom we have to serve them. Could be grappling with, would it be right, would it be wrong, which one to go, how to go, and hence, and sometimes paying tax might be more fruitful than even taking out that much money to even save tax, so that sometimes, and it's very, and any decision that you and I as individuals take in terms of understanding and tax efficiency, it must be favoring us as an individuals, right? As an individual, if I choose a product, it must favor me. And that's where the whole idea of looking at how the cash flow management should be. How do we start in the beginning? April is the beginning of the financial year. That's what I meant by beginning. And then we plan it much before, maybe March or Feb. We plan for the next financial year to see how we go about things like that. Then it's important to also look at right tax saving products, because they also help in our fulfilling on our medium to long term objectives while giving us the tax benefits incidentally. That's one of the things, and we are going to look at some of those products. May not be elaboratively, but maybe we will have a glance of how do we understand those products and take it forward. Then we will look at how can we optimize all available options for the tax planning. That's very simple for today's session, right? So please feel free to put your messages on the chat box. So we know that this was the old tax regime, the only tax regime perhaps that we had before 2020-2021 financial year, and it was in the year financial 2021 that we had two kind of structures: the old tax regime and the new tax regime, right? So OTR, NTR, I would say, yeah. So option A is the old tax regime over here, and option B is the new tax regime. So what happened was, after a new tax regime being introduced in 2020-2021 financial year, it has also undergone a change last financial year, and that is with effect from this financial year 23-24. And that's where we are going to see with slight differences. So in the interest of time, I'm not going to go over what was that previous, in 2020-2021. So we are going to focus on what is there available currently with us, and that is what is available in front of the screen that you see. We have option A, that is the old tax regime for individuals who have income tax levels at various brackets over here up to 2.5 lakhs. This is for those people who are 60 years and less, right? So for people who are 60 years and more, senior citizens, the exemption limit has been 3 lakhs, is always 3 lakhs, and same is the case for people who are 80 years of age, where the exemption limit is up to 5 lakhs net. So we are going to focus our conversation predominantly on 60 year, less than 60 years, so a resident individual who has that. So if you clearly see up to 2.5 lakhs, there is no nil, and then 2.5 to 5%, 20% after that, and 30% after that. One can really choose, have to have that according to their total income that they have in hand, or they can go for option B. Now, earlier, what happened? There was a choice for the individual to look at whether I should go for the old tax regime or I should focus on the new tax regime. From this financial year onwards, the choice, there's a default choice, okay? There's a default option. If we do not choose old tax regime, all of us will automatically be getting into, but that's a default option, okay? Option B, or the new tax regime, has become the default option. Unless otherwise you and I as individuals would want to select the old tax regime, then only we'll be able to. And this option is there once in a year. These options can be changed based on various situations. Financial lifestyle situations may change, evolve, and things like that. So in this year I might go for old tax regime, next year I might continue with the new tax regime. Similarly, every financial year we have that option, and accordingly we can plan the tax flows, the cash flows, and also the options that are available with them. Now, as you see here, in option B, that is the new tax regime, the income levels are up to 3 lakhs, it is nil, and the total income and various others are slabs are available for you to look into that. I will request my colleague later to share our tax reckoners with you, which will give you a very detailed description of what this is all about, just to give you a glance. One of the important things that individuals must understand when they are planning their taxes, definitely whether I should come into a old tax regime or I should look into a new tax regime. This is one of the things that people can come into. In the new tax regime, there is a revision also. Individuals who have a total income not exceeding 7 lakhs. So if they are falling somewhere between 6 and 9 lakh bracket, and their income is somewhere around 7 lakhs over here. So let me just have the pointer. Yeah. So if their income is over here somewhere, then up to 7 lakhs, they can avail a rebate, either lower or lower of actual tax liability, or rupees 25,000. So somebody's income is exactly 7 lakhs, let us assume. Hence, if you look at the incremental tax brackets, so whatever is that 5% from here to here, you get some 15,000 rupees is already here. And in here, if you look at 7 lakhs to 6 lakhs, whatever is that over here, it comes to about 10,000, considering that the income is 7 lakhs, okay, maximum 7 lakhs. Then 15,000 and 10,000 together is 25,000. So anyway, that is also a rebate. So literally, persons who are in the bracket of 7 lakh, per annum, do not have to pay any tax under this tax regime, under this new tax regime. They either have to, they are exempt from the 25,000 or less, because somebody having 6.5 lakhs instead of 7 lakhs, their tax treatment will be according to the calculation as we have, said that. That's one of the things. And another thing that got introduced in the new tax regime is a standard deduction, which was available with the old tax regime, has now been made available to the new tax regime, under the new tax regime as well. So that is also available. But one thing that must be very glaringly understood here is that if an individual is choosing the new tax regime, that individual must forego all the benefits that they might have invested under the section 80C, 80D, 80CCD, all those, under section 80 C to 80U. All so many sections are there. Okay, so but they have to forego that. So there is no point claiming any deductions against those options. It will not be possible under the new tax regime. So home loan will not be possible. Home loan interest deduction under section 24 is not possible under the new tax regime. Same is the case, to 1,50,000 under section 80 is not possible. We will cover a little bit about all those things as we move along. But an important point to note is, while choosing old tax regime or a new tax regime, which will be more favorable for me from the cash flow point of view? If I'm already into some of the investments and also it is giving me a tax efficiency, then would it be better off for me to continue with old tax regime, or should I, because of the so much benefits that we have under the new tax regime in terms of SNPs, should I choose new tax regime? Which one is better? Okay, we'll have a quick glimpse of various income tax brackets that we have over here. So if you look at how you see this in tax, this is option A, that is the old tax regime, and various total taxable incomes presented over here. Now you look at 4,75,000 per annum. Okay, these are all per annum. And 8 lakhs to 10 lakhs, 15 lakhs, 56 lakhs, 1 crore, 2 crore, 5 crores, up to 1. This is just to give an example of what could be the differential. Differential is already out there for you, but we're just going to focus on what is available for somebody who's coming into selecting an option A, or selecting this time on this year onwards. From this year, or at least this year, I would say that, if somebody selects old tax regime, because new tax regime is default option, there is no point selecting it. It's already been selected for individuals unless we take that, right? So various tax income, how much tax is liable for each of these income brackets. Now, what we have considered here, just for a quick glimpse of this, is we have considered 1.5 lakhs of section 80C. We have not considered home loan, we have not considered section 80D, which is, the medical insurance and all that thing. We have not considered all those calculations, but for a quick glimpse, we have considered only 1,50,000, considering that an individual has saved complete and to the full of section 80C, that is 1.5 lakhs per year. Then what would be the tax liability? And that is where we have some calculations, and this also we can share it with you as a tax reckoner that we have with us, and we will I will request Soham, my colleague Soham, to share that with the team here. So clearly you look at, friends, the benefit is currently seen in going for the new tax regime only. See the differential over here. So somebody would have, even if somebody would have invested 1.5 lakhs and availed the Section 80C benefit, now still the the new tax regime would be beneficial by so much of amount over here. So 39,000 versus 49,000 in older tax regime, 62,000 in this income bracket, 10 lakh bracket versus 85,000 in the old tax regime, and so on and so forth. The maximum benefit perhaps in terms of percentage, I would say, right? Not in terms of value, but in terms of percentage, the maximum impact that is seen here in the 15 lakh income bracket over here, where one could pay about 226 maybe after considering the 1.5 lakh Section 80C products over there. However, you see the differential between this figure and this figure. So an important point that I would like to just share here is we as individuals do not want to burden ourselves by saving for tax. It should not. Sometimes we might slip out, sometimes we may not have planned. Some in this financial year, some people, it is not for you and I, probably we already are aware in many aspects and nuances around, but some might not be aware, or they might be dealing with some cash flow issues, and they might not be pressurized under they should not be left with some kind of a feeling that I would have missed the opportunity of saving for tax. So don't have to worry about it. Because you have forgotten, this is what you would be benefited out of it. And maybe in the next financial year when it comes, they can continue with whatever works for them at that financial year. This is just to show that, friends. The rest of all is right there, the differential on various income tax brackets over here. So for this particular session, if we were to go into old tax regime and new tax regime, this slide number 5 that we are on, is sufficient for us to understand the bracket and the benefit of being in the new tax regime. In a way, the differential of being in the new tax regime. From now on, if somebody is in the old tax regime or chosen old tax regime, how efficiently one can look at in their cash flows, in their choosing the right options and the tax part of it, and then make their investments and the decisions a little more meaningful for them, right? So that is the whole idea of showing this. Friends, as I said in the beginning, the calculation that we did here and to show you which is beneficial and all, in those calculations we have considered the Income Tax Act under Section 80C, where the maximum limit to claim exemptions is for those investments or expenses that have incurred in that financial year under Section 80C. And under Section 80C means 80C, 80CCC, 80CCD, and all those comes under the sections of Section 80C, right? So let me begin from the right hand side of the screen over here, expenditure based. So if somebody might not have planned to save for their taxes, so if they would have incurred some of their expenses here, so that can always be chosen to claim deduction under those heads. So for example, any insurance premium, for example, term insurance premium, it is considered as expenses because all that we give is only premiums, so we don't get the premiums back. That's the pure risk about it. Because we don't get, and the sum assured might be much larger to facilitate the family's obligations, then those premiums are also exempt from tax. So those in case some of those expenses are there, and that's why we relate to them as expenses, because they don't come back into your kitty. Same is the case with others, education expenses, up to a tune of 1.5 lakhs. If you have if someone has their children, they have to make use of their tuition fees, the receipts, and specifically in the education expenses also, a particular item called tuition is considered. by and large, not the entire fee, entire tuition, school receipt or academic fee receipt has so many items in it. The main item will be the tuition item among all the particulars, and that is exempt from tax if we for 1 or 2, but maximum up to 1.5 lakhs combined. Somebody would have bought a residential property at the stamp duty, whatever is the stamp duty and registration charges for that house incurred. Again, that can also be claimed under Section 80C with an overall limit, combined limit of 1.5 lakhs. If stamp duty would be somewhere around, say, 1 lakh rupees, and then you have another 50,000 that you might have invested in others. So that will be the overall. Maybe 20,000 will be your education expenses. 10,000 will be your insurance, term insurance premium. So you have 1 lakh 20 plus 10, 1 lakh 30,000 plus another 20,000 if you would have taken a home loan, then the principal component in the EMI would also is available for them to claim tax under Section 80C. Friends, we must have this always in mind that all these benefits are not available in new tax regime. In the old tax regime, only all these are available, including the interest, under Section 24, home loan interest up to 2 lakhs per annum. That is also can be availed under the old tax regime only, right? So this is about expenditure base. One need not burden themselves again into the cash flows for saving tax. Yeah, so that is the whole idea about it. How best we can utilize the existing resources that we are spending or when we are investing. Now let me come to the left side of the screen over here. This is investment based. Most of us might be knowing about it. In the tax structure, you have 3 categories of tax structure. That's how you will look at it. One is at the investment base. Whenever you make an investment, that investment is exempt from tax under Section 80C, and hence that's the first exemption part, E, right? And some of these pay interest, and those interests are also not taxable. So that is the second exemption in the category. And the third exemption is when you withdraw. In some of these products, once you withdraw that, the whole withdrawal amount that you have in your hand is also exempt from tax. So you don't have to pay any tax on that. So that is the third category of the exempt. So we have overall 3 categories of exemption. Exemption at the investment, exemption at the interest income that we are earning on that, and exemption at the proceeds that we receive in the hands. Not all products are EEE. Only few products might be, couple of products might be EEA. The rest of the products might be ETT, that is exempt, taxable and taxable. So that is how we have to understand these products. So whatever products that you see here on the left hand side, we will start with the debt. Debt are very safe, absolutely safe, and some of them, many of them are having assured returns. So the debt is absolutely meant for a capital safety and assured return. Those kind of investors it appeals, and then hence once they are investing for that purposes for a capital assurance and something like gives them a kind of a confidence to be in those. So those products are also there. However, not all debt products come under exemption. Only the one that you see here comes with various features. Friends, again, I'm going to share this here. We are not going to go over the features, advantages, and benefits of all these elements that are there, but we are going to look at 2 points, critically 2 points that will help us to plan for various goals that individuals may want. What is the 2 points? The first point is the exempt category, whether it is triple exempt or single exempt tax. That is the category. The second point that we are going to focus is on the liquidity. See, when we want money, how soon we will want to have money without any much hassles. So we have to get that also and comfortable to get that money, and hence the liquidity or the lock-in, whatever we may say. So some people say liquidity, some people may say lock-in period, right? So these are the 2 broad points, pivots that we are going to understand around these particular products. So from here, let's look at the debt. 5-year notified fixed deposit that comes under Section 80C, which has a 5-year lock-in, exempt but taxable. Of course, there are nuances around it. Some people say, okay, interest is tax-free. Interest from the deposits is exempt up to 10,000 rupees in a financial year. If it's a senior citizen, it will be different. So we are literally not going into those kinds of nitty-gritties, but more or less broadly, we are going to understand how that general feature is, broad feature of that particular product is. So this comes under exempt category, but TT, that is ETT, and of course it has a 5-year lock-in over here for the liquidity purposes. One must wait for until 5 years. Only then they will come and they will avail this benefit. Provident fund, again, and again for 5-year note, this thing, the maximum anywhere we know that it is 1.5 lakhs only. Provident fund, we have different kinds of provident fund: employee provident fund, public provident fund, voluntary provident fund, all these things. Just to touch on public provident fund, the maximum one can invest in a public provident fund is only 1.5 lakhs per annum. That's it. Mainly because this helps public provident fund product helps specifically those entities which are not in an organized sector, like employment structure, where do not get to have any pension plans or any of those things where they have an organized way, like any employees will have a provident fund. So for those kinds of people, public provident fund will be helpful. Again, it comes with a 15-year lock-in, the general lock-in with some kind of a help given, and I'm using the word, benefit given if somebody wants to take a loan on that. But this one category is exempt category. So somebody wants to have the benefit of all the 3 exemptions, public provident fund for that matter, is that product, which comes with its own liquidity. Again, as I said, National Savings Certificate also comes. It's also a sponsored small savings scheme with assurance from the government, and it has again a 5-year lock-in. So lock-in period is 5 years, but it is coming under the exempt category only. Okay, one exempt only. So the others are taxable. The interest that is earned from these products is taxable. Okay, and withdrawal also, whatever amount is given in the hands is also taxable for this particular product. One good thing about this is, while in this product there is a maximum limit, all these 1.5 lakhs is the maximum limit over here. Same is the case here. In here, there is no maximum limit for investment. There is a maximum limit for claiming tax benefit, which is again 1.5 lakhs. So you should say that it is not 1.5 lakhs, 1.5 lakhs, 1.5 lakhs. All put together must come under that only 1.5 lakhs, right? So there is no maximum limit. People who may want to have, can have any limit over there, but tax exemption will be given only on 1.5 lakhs maximum. Yeah. Sukanya Samriddhi account is one such product that has that you and I know that is for the encouraging the girl child in the families, and hence it is one product that is also exempt for girl child who is below 10 years right from the birth, can invest in that product, and then the girl attains majority. And otherwise, for a period of 21 years, it can be, the investment can be, the term for the investment can be held. Now, this is a exempt category too. So the investment is again exempt, and the interest earned out of it is also exempt from tax, and the proceeds that one gets, the girl, what for the purpose that it is also exempt from tax. That is the second category of the exempt after provident fund, right? Then there is a 5-year post office time deposit. Again, the moment I say 5 years, there is a lock-in period of 5 years. All of them are coming with their lock-in minimum 5-year lock-in periods is what we have in the debt side of it. Senior citizen savings scheme also qualifies under Section 80C. However, this is for 60 plus. Again, exempt category, but interest again is taxable, and the proceeds that we get is taxable in that. So these are the key pointers while planning for tax efficiencies for investors or for taxpayers who would want to look at efficiencies in the product. Then there is another part, hybrid. Hybrid is nothing but it's a combination of debt and equity over here. So basically all the life insurance plans which has ULIPs, unit linked insurance plans can be one, and pension funds can be one, which fall under section 80 CCC. They also come under all the pension funds, etc. And NPS that comes under section 80 CCD, CCD 1B, all those which we will probably touch a bit about that as we move along. Right, these are also now some of the policies, some of these products are exempt if it's from products, endowment policies, whatever is the proceeds that we get is exempt from tax, but some of them are not completely exempt. For example, if it's equity oriented, they are just exempt from the capital gains perspective, but not the entire proceeds part of it. Same is the case with NPS. NPS, if you're in having up to 60 years, at the end of 60 years, 60% of the NPS corpus can be taken out without having any tax. So that's tax exempt. And the rest 40% will remain in the annuity products. That is the structure, the product structure. Coming back to the key point, okay, equity linked savings scheme, that's a mutual fund. That is one scheme that has benefits. It's exempt, number one. And the investment is exempt, and the income that we earn in terms of capital gains in that is also exempt from tax, subject to a limitation, right? So overall limitation to 1 lakh is exempt. Long-term capital gains tax in equities are anyway exempt up to 1 lakh. Over and above, there's a 10% long-term capital gains tax. So ELSS falls under that, and hence exemption is up to 1 lakh if in 1 year. Okay, in one financial year, if the gain is up to 1 lakh, that includes the gain of ELSS also, then that is exempt from tax. The proceeds are anyway taxable, that is what, as I said, So these are various ways that one individual can look at if they are coming into an old tax regime. If you want to still continue in the old tax regime, they can still continue with those benefits over here. So again, as I said, good point that I probably missed that in the previous slide. See, section 80C up to 1.5 lakhs ELSS is there again to the total investment, but the lock-in period is only 3 years. So among all these products, if you see from the liquidity perspective, this is the only product which has got the minimum lock-in period of 3 years. So after that, one can really withdraw for various needs that they may want to have. Right? So again, like National Savings Certificate, this product does not have any maximum cap on the investments. For example, I as an individual can even invest 5 lakhs into that product. However, only up to 1.5 lakhs is qualified for under section 80C, but the rest will continue to remain if I choose to keep it that way and lock in my product till my whatever is the goal over there that I would want. All these products come with various modes of investments according to the wallet, ease of the wallet. When I say that, you want to have lump sum is available through staggered investments are also available, which we generally call it in the mutual fund parlance systematic investment plan. Right? The few things that we would want to cover on the amendments on the provident fund part of it. So these were few amendments that was made earlier. What happened, there are so many amendments being made, and I like this, to state the government is also trying to plug all the loopholes, that were there in terms of tax leakage, okay, or tax collection leakage. Earlier all the equity schemes were long-term capital gains tax was exempt, and that had a massive benefit for many investors. Could go, and now today we have long-term capital gains is taxed at 10% after 1 lakh, beyond 1 lakh. So that is one. Same is the case. If you look at everybody wants tax-free income, the higher the tax-free income, the better for them, right? So Provident Fund was one among that. Public Provident Fund anyway maximum is 1.5 lakhs only. So what employees did earlier, Employee Provident Fund, they voluntarily also contributed to the Provident Fund through a voluntary Provident Fund contribution. what happens, everything once they get in terms of return, that is interest income and then proceeds, are exempt. For that purpose, there is a clause that was introduced in April 2021. That is to say, if you look at interest on employee contributions to the provident fund over 2.5 lakhs per annum would be taxed. That is what. What does it mean? So I will straight away jump into the point number 4 as an example that will help with this understanding. Supposing someone has a basic salary, okay, in the entire cost to company structure, CTC structure, there is a basic DA and all that thing. So somebody has got a basic salary of 1 lakh, and then the monthly contribution is 12,000, which is about 1.44 lakh, right? So naturally 12% of 12% of basic is your your provident fund over here. So automatically it will translate into 1.44 for that employee. But if an employee wants to contribute more and says that I will put more money, I will contribute another 12,000. So that is what? Another 12,000 is another 1.44 lakhs per annum. So that is 2.88 lakhs per annum that employee is contributing, presuming that he or she will get a interest free income and the withdrawal also tax free, right? So that's where the government has plugged that loophole and said, okay, up to 2.5 lakhs can be exempt, but over and above will the remaining amount will be taxed at marginal tax bracket, whatever is the marginal tax bracket, 20%, 30%, depending on the one's marginal tax bracket. This is the key point. Instead of moving to 2, 3, I straight away came into the example of point 4, and that got plugged one. And another amendment that was made is at the time of withdrawal. If somebody is into the provident fund, employee provident fund, and the person has not completed 5 continuous years of staying invested in PF, then the withdrawal amount will be taxed. So one can say that I'll take my PF and go off. That PF is also after 3 or 4 years of service and not continuous service, and then want to withdraw the PF, that PF will be taxed, and it is not exempt. So for that to remain exempt, one has to have 5 continuous years of staying invested in the EPF. That is one part. Under Section 80D, an important part, see, first and foremost, the companies or the organizations will definitely take care of their employees and hence will have some kind of a safety net for their employees in terms of medical insurance facilities for the person, for the employee and their family. Sometimes there could be a limitation, maybe only 4 people, 5 people, depending on whatever is the structure the company has. Over and above, in a personal financial planning context, one must take a medical insurance for them, adequate medical insurance to support the family health needs. That is important. And in my experience, friends, I'm telling you, I have seen that people would buy those policies for tax benefits. So literally take a medical insurance only to serve the need of covering the health, and you individuals are the best to judge what kind of health needs are important, are there, or can be anticipated, and take that over and above the whatever is the organization is giving, right? So for self and family, even if it is outsider, an individual who was a businessman or so, it's important to understand that we help them in those decisions. So for self and family, up to 25,000 is exempt. It is not that 25,000 is maximum for health needs. It can be more than that. But if medical insurance is 30,000 taken, up to 25,000 of that is exempt from tax under Section 80D, right? And same is the case, so on and so forth with other places as well. There is self and family is 25,000 plus. If I am buying a policy for my parents, so I can always buy another 25,000 is exempt. I might buy for another 30, 35 or 40,000 for my parents, but in that also up to 25,000 is exempt. So for mine and my family 25,000 and my parents another 25,000. I should not buy the product to cover that 25. I should buy the product to cover adequate risk for mine. So this is one. And self and family senior citizens, right there. I don't want to go into details. That is right in front of us in the screen. 25 to 75,000 if it is a senior citizens, and and various others. 50,000, 50,000 up to 1 lakh. If the individual itself is a senior citizen and is covering for their senior citizen parents, so up to 1 lakh is exempt from the tax from the Section 80D. See, these are some of the needs that are there, that are required, and hence there is an also option to see how best that I will spend on that and also get some tax efficiencies in that. That is the whole idea of looking at these products not from tax saving alone. Yeah. And so on and so forth. Friends, another thing that's important is whoever is taking that medical insurance up to 25,000 is anyway comes under Section 80D exempt from tax, plus another 5,000 if you whatever is your health checkup in a year that costs whatever it costs. The health checkup might cost 7,000 also in case for you and your family, but you can claim up to 5,000 under that. So 25,000 plus 5,000. Once you spend on that, you can actually show the receipt and claim exemption on that as well. So for all these aspects, this is also available. So these are some of the things that can be utilized under old tax regime. Which one is favoring, as I said in the beginning itself, which one is most favoring for you? You are the best judge. You will individually evaluate and see where you are spending, and how best you can make your spendings. How efficiently you can do that. That is the whole idea of sharing this. The last part of today's aspect session is Section 80CCD, which again comes under a subsegment of Section 80C, that is the NPS. So NPS is again, this was introduced in 2004 for all the government, as for all the central government employees. It was introduced then 2004, and moved to defined contribution from defined benefits. That is how we want to contribute ourselves. Our government keeps supporting at some point of time. We also as individuals, and that's the whole idea of defined contribution. So 2009 onwards, this defined contribution is open for individuals also. Earlier it was limited only to the government employees. Now, again, the tax benefits here in this is you have both under Section 80C. This can come under the 1,50,000 that we spoke of in the beginning. And what if I am a subscriber, if I have taken tier 1 account of NPS and I am contributing some 10,000 or 20,000 in that per annum, I am doing that in that fund. So that 10,000 and 20,000 can also form under Section 80C, and included in 1.5 lakhs. In case I have exhausted my limit, now not only subscribing within 1.5 lakhs, in case there is a corporate who is also a subscriber for NPS and their employees are also there. So their employees' salary slip shows the contribution towards NPS by the employer. So 10% of their income, is also deductible. Claimed under Section 80C 1.5 lakhs bracket. Okay. Over and above that, once I have exhausted the entire 1.5 lakhs, what if I want to still contribute and take advantage of? So I have another 50,000 where I can additionally invest. That's a maximum that I can take the benefit of. So there is no maximum limit into NPS. But for tax benefits, another 50,000 if I under Section 80 CCD 1B, I can invest there and subscribe to that and claim exemption. So 1.5 lakhs plus 50,000 of this part 1B. So friends, one thing we must keep in mind here again, the maximum deductions as an aggregate, whether it is 80C, 80CCC or 80CCD, all that we have seen under that 1.5 lakhs. Okay, 80D is not under 1.5 lakhs. The medical insurance that we have covered does not come under 1.5 lakhs bracket. It's a separate head altogether. So should not exceed 1.5 lakhs. But after including 80CCD1B, that is additional 50,000 over here, the deduction limit becomes 2 lakh. So somebody who's having a home loan where the interest payment is more than 2 lakhs, so 2 lakhs is straight away deductible from the gross, and the home loan, the EMI, the principal component in the EMI, up to again 1.5 lakhs in a year, that qualifies under exemption. And all these are available. Again, if somebody is in NPS, then another 50,000 one invests in that, so that is again over and above Section 80C. This is qualifiable, and all these are there. These benefits are available under the old tax regime. As I said, which is the right one? Individual is the right person to judge, how the cash flows are, how it is being used, how best they can be utilized for fulfilling various goals and creating a tax efficiency while planning. So there is nothing like only that option is good or option B, that is old tax regime or new tax regime. It is absolutely individual. Sometimes in the 1 year I might feel new tax regime is better, and next year I might feel old tax regime looks little better. So depending on my cash flow requirements and how I would want to make use of it. So that was the whole idea of this so-called personal taxation, importance of tax planning. The whole session is only about understanding the nuances around that, and I hope this has been really valuable to you. We have kept the mutual fund taxation specifically away from this session, because the agenda of a mutual fund, understanding a mutual fund taxation will be totally different, and it takes another maybe an hour or so to understand the nuances around that. We take medical insurance in our family. I hope we do take medical insurance, many of us, including myself, right? So for us and my family, and we are spending thousands and thousands on that, if not lakhs, on the medical insurance. When we are looking at those aspects, then if we would also want to take advantage of the opportunities available, those kinds of people would like to choose that. Otherwise, as you rightly said, sir, old tax regime has no relevance. It is much, and that is the whole idea, that the government also has come out with new tax regime number 1 and made it default option also. That is the I hope I answered the second question also. But there are cash flows. As I said, what is important is cash flows and the expenses that we are having and how best we want to make use of it. Many people may want to avail home loan and take the benefit of that. But even if you consider that, deduct 2 lakhs of your interest, deduct all that, whatever is there under Section 24, and see, sometimes you may find it beneficial by being in option B. Then option B will be ideal if you are looking in this kind of a bracket. But anything above than this, it hardly matters whether somebody is in old tax regime or new tax regime. It hardly matters. So it is just a psychological what do we say, that comfort of, okay, whatever I'm investing, I'm at least making use of it. But however, broadly, if you look at it, there's hardly anything on a percentage. You see 4% to somebody in this income bracket, this hardly matters actually. And you are right, sir, on that. I hope I answered.
Please subscribe and press the bell icon to never miss another update. Please like, share and comment.